here today, and hopefully we can impart some information that the attendees find useful in managing their real estate tax assessments of their golf course properties. We're certainly in unique times, and hopefully we can take a little advantage of those unique times, especially after so many of you have had your courses mandated to remain closed until recently. So let's get started and talk a little bit about that. I've also put my email and my website up here if you want to talk to me or reach out to me at some point about a specific situation that you may have with your property. I'll happily review it and give you my thoughts on how to manage your assessment and move forward. So that being said, one of the things that I've noticed lately, and I've done a few of these webinars, is that we've kind of lost, everybody's online and talking and doing things virtually. So I thought I'd give us a little bit of give you a little locational sense as to where I am and where I'm located, so that there's some locational relationship here. I'm in the Philadelphia area, a little northwest of Philadelphia, where the logo is on the screen, very close to the Philadelphia Cricket Club. And you can see the locations of Pine Valley, Cobbs Creek, Marion, Aronimink, Glen Mills, and Downingtown, some of the significant both private and public courses in the Philadelphia area, relative to where we are here in our office in Conshohocken. And there might be a prize for anybody that can spell Conshohocken by the end of the webinar. This is a view this morning of our office space, our office building, and as you can see, there's not much traffic. This is usually a very busy street, and you know, that right there tells you probably as much as you need to know in a general sense about the impact of coronavirus on what's going on in the world today. There's not much happening. Pennsylvania is still under a stay-at-home order. Some businesses are permitted to operate, others not. We can't go out to eat. Most of the restaurants, as you look down the street, there's a whole bunch of restaurants here. Most of them are closed. Some are open for takeout, and it's a different world we live in. Let's talk a little bit about real estate taxes for golf course properties, and then we'll talk a little bit about the impact of the coronavirus. I want to first of all talk about some of the fundamentals that exist, the elements of real estate taxes, a definition of value, the approaches to value, the differences in process and jurisdictional differences that exist in doing real estate tax assessment appeals, highest and best use, and then the issue of cost versus value. Then we're going to kind of switch gears, and we're going to talk a little bit about the impact of the coronavirus pandemic on the value of golf properties, which relates to how much your tax assessment should be. We're going to talk a little bit about the buyer's market, something I call snapshot values, what the determinants of value are, long-term and short-term impact, distressed courses and capital needs and how that impacts your assessments, and then what the future may hold. And no, I don't have a crystal ball, but hopefully we'll raise some relevant questions that can help you. What is market value? Well, first of all, market value is the primary element of real estate taxes and tax assessments. Once you know what the market value of a property is, then you can apply what's known as either an assessment to value ratio or an equalization ratio or rate. And that results in what your assessment is. Sometimes you may look at your real estate assessment and say, well, gee, that doesn't make any sense. That's nowhere near one way or the other, higher or lower, my value of my property. And that's because of the equalization rate that may be applied to the market value, to determine the assessment. Once you get the assessment, the millage rate, which is set by the school district and the municipality and the county, maybe the library, maybe there's a fire department tax, something like that, that's applied to the assessment, and that results in what you guys feel as golf course owners in your annual tax liability. The key thing to walk away with and understand, hopefully today, or one key thing, is that you can't fight your taxes. You can only fight your assessment, and you can only fight that as a function of market value. There's no process for appealing your millage rate, and there's no process for appealing what your annual tax liability is. You can't go up and say, I'm paying $100,000 in taxes and I only want to pay 50. You have to do it through the avenue of market value and then applying the equalization rate to result in the assessment. Market value is the most important concept here. And I'm going to read the definition because there's a lot in that definition that is really relevant and important to your ultimate tax assessment. The market value is defined as, and the definition varies a little bit from state to state, but it's usually something very similar to this, which is the appraisal definition. The most probable price as of a specified date in cash or in terms equivalent to cash or in other precisely revealed terms for which the specified property rights, the property, should sell after reasonable exposure in a competitive market under all conditions requisite to a fair sale, with the buyer and seller each acting prudently, knowledgeably, and for self-interest, and assuming that neither is under undue duress. And the two most important things to take away from the definition of market value are A, it's as of a specified date, and that becomes very relevant in the coronavirus time, and B, it presumes a sale. It presumes that there'll be a sale of the property. So a lot of times what I find, and I'm doing a webinar next week for the assessors organization, is they look at golf courses and say, well, it'll cost X to build because they work in a world of cost. Cost doesn't mean anything. And we're going to talk briefly about that as we go through today. But these are the two most important things. A, the definition of market value presumes a sale, and B, it's as of a specified date. And both of those are very important. The approaches to value, there's basically three of them. There's the income approach, which measures the present worth of the future rights to income, or what is your income stream worth. There's a sales comparison approach, which compares sales of other golf course properties to your property and results in a value indication. And there's the cost approach, which I mentioned. I'm not a fan of the cost approach. However, in some states, it's required to be used, not necessarily by itself, but it's required to be used, and often judges in those states will make their conclusions in tax cases on the cost approach. There are derivatives of some of these methods, most notably the income approach, which is the approach I think most people like to use when valuing golf courses. There's a discounted cash flow, which projects cash flows and measures their worth out into the future, maybe if the property is not stabilized or there's growth to be experienced. The bridge model, which basically uses a concept of what was the property worth the day it opened, so that there's no business value associated with it, because when we're doing real estate tax assessments, we're not looking at the going concern value, we're only looking at the real property value. And that allocation is a big part of the process. The stock and debt approach, which is reserved mostly for private clubs and isn't a very reliable approach and doesn't reflect market value. But in fact, in California, the stock and debt approach is in the California Assessor's Manual. And then there's the market rent method, which is used widely in New York State and a few other states. It's been used, but hasn't been dictated for use like it has in New York. And basically what the market rent method does is utilizes leases of golf courses and measures those leases for an indication of market value by capitalizing the rental rate. I'm not a fan of the market rent method, but again, where you have to use it, you use it, and hopefully you can develop a reliable indication of value from it. By the way, if anybody has any questions as we're moving forward, don't hesitate to ask during the presentation. I'm happy to pause and answer them as we go forward. Each state, each jurisdiction has differences. In some states, you are appealing to the town. In other states, you're appealing to the county. The process might be different as to whether you file an appeal and then go to a board or go to a tax court. There are different accepted approaches in the different states. The assessment to value ratios or equalization rates that we talked about a couple minutes ago, those can be both different in number and different in how they're applied. So there's lots of different ways to go about appealing your assessment, and it's really important to know the process so that your appeal doesn't get thrown out. You need to know what the date of appeal is, which it's different in every jurisdiction. In some states, they don't let you use the income approach in favor of the sales comparison and sometimes the cost. In other states, they only want to hear the income approach. So it's important to understand when we do an appraisal for a tax assessment appeal, what the customs and the procedures are in that state and what the case law is so that we know how to present our valuation so that it's accepted, especially should we go to litigation in the appeal. Some states are what they call highest and best use states. Other states are continued present use states. Most states are highest and best use. And what that means is that if you have a property that is suitable for residential development, and maybe it's worth more for that use than it is for use as a golf course, then it has to be appraised as a development site, not as a golf facility. In New York State and in limited fashion in a few other states, Illinois, Maryland, and a few others, they have some kind of interesting idiosyncrasies that you can appraise the property or value the property based on its continued present use. The most prominent of them is also, in fact, New York, which clearly dictates that golf properties must be, and all properties must be assessed based on their continued present use. What that means is that you have a lot of golf courses in New York State that are on very, very valuable pieces of land, and the assessors and the town governments and the county governments would prefer that they be assessed as development sites, but they can't do that in New York State. So that's kind of an interesting wrinkle that they have there. And as I said previously, sometimes you're dealing with the town, sometimes the county, sometimes the state, and almost always you're dealing with the school district in any given jurisdiction who has the right to join the defense of the appeal and often controls it because they have the biggest percentage of the taxes that are coming to them versus the other taxing authorities. So jurisdictional differences are important to know, and depending on where you live, you know, I could answer specific questions potentially about your state and your jurisdiction. Allocation is very different in the different jurisdictions. What I mean by allocation is, as we all know, golf courses are a going concern business. And when golf courses are bought and sold, they're not sold just as real estate. They're sold as a going concern business. However, real estate taxes are only to be applied to the real estate. What that means is that if you have an income stream that indicates a certain value, you now have to allocate or separate the real property value from the going concern value. Assessors rarely do that. It's not in their best interest to do it. The procedures for doing that vary from state to state. In the appraisal world, there are several methods of allocating real and personal property. Quite frankly, none of which are particularly foolproof. It's important to do whichever method seems to make the most sense for the property that's being appraised. Interestingly, in New York, they use the market rent method, which supposedly isolates real property value so that no allocation is necessary. In Florida and South Carolina, for example, what they do is remove from the income and expense analysis the pro shop, food and beverage, and golf cart revenues and expenses. And that creates a very, very different income and expense pro forma than if you included those things. In Illinois, they assess the property that the clubhouse is on and around the clubhouse where the parking lot is differently than they assess the golf course property. The golf course property is assessed pretty much as open space, whereas the clubhouse facility and surrounding property is valued differently. In Pennsylvania, there's really no specific method that's been dictated by the courts. So we use one of the methods that is out there to allocate real and personal property. And those include things like the management fee approach and the return on investment approach, where you separate the components of a golf course and allocate income towards them. And there's several other methods that are out there to allocate real and personal property. That is actually one of the more difficult things that appraisers do, is allocate real and personal property, whether it be in a golf property or a hotel property or some of the other types of properties which are going concern businesses. In some states, they have some specific legislation. In New York, they have the legislation that dictates that it be assessed based on its continued present use. Last year, there was rumblings in the New York legislature that they were going to change that and allow the assessors to value the properties based on their development use. That was defeated, and it's still continued present use in New York, which is good for golf courses. In Maryland, they were also having some legislative conversations about giving more highest and best use oriented assessments to golf courses and in particular private clubs in and around the Washington, D.C. area. But that has not succeeded yet either. In Virginia, they had a situation in Arlington County where the state legislature got involved and was going to pass a law, or did pass a law, the governor didn't sign it, that clubs had to be valued based on their continued present use as opposed to their highest and best use. And the governor did not sign it, asked the parties to get back together and negotiate a settlement, which is ultimately what happened. In Ohio, there is some rumblings going on about the way the property appraisers or assessors in Ohio do assessments, and we're kind of still following that as we speak, and which approaches they use and how they go about assessing property. So as you can see, it's very different no matter where you go. The appeal process. First of all, the first thing you have to realize is, what are the dates? In New Jersey, you have to appeal, I think, by either March 1st or April 1st using an October of the previous year valuation, whereas in Pennsylvania, you don't appeal until August 1st or September 1st, depending on which counties you're in. And that varies no matter where you go. Sometimes the value date's January 1st, sometimes it's June, sometimes it could be any point in time during the year. So the first thing you have to know is, A, what are the deadlines for filing in each state? And secondly, what are the value dates that are used for each year's assessment? In most cases, the next thing you do after appealing your assessment is appear at an appeal board hearing. Most jurisdictions have a politically appointed assessment appeals board, and you go before that board and basically state your case. We will often take appraisals, most of the time take an appraisal into that board, present the appraisal to them, explain to them why the value is what it is and why the assessment might be unfair, and make our case. Rarely are boards willing to make large modifications in the assessment. Sometimes they do, but more than likely they would rather see if the property owner is going to appeal in court. Sometimes it's in local court, sometimes it's in county court, and sometimes it's in state court. In New Jersey, they have state tax courts, and there are other states that have that as well. In a lot of states, you just go to the county common pleas court and state your case. A lot of times there is a potential refund involved. And this refund often becomes an element in negotiations that might occur before trial. The risk of trial is one that a lot of people don't want to take if they don't have to. So there's usually negotiations in any tax assessment appeal. And I would say most cases conclude before they get to the litigation phase. That being said, I urge all my clients to move forward as if they plan to litigate and be prepared to litigate, because that's the only way you're going to get a satisfactory resolution through negotiated settlement. So it's really important to understand the process, understand how much time it takes, understand how much it might cost. There are people out there that do tax assessment appeals on contingent fees and take the risk off of the property owner. On the other hand, with that risk, the cost usually, with mitigating that risk, the cost usually goes up. So if you have a good case, if you have a real solid case, I would recommend normally evaluating your case to find out how strong it might be before you go and give a big chunk of your savings to somebody who isn't going to do as good of a job from the perspective of being on a contingent fee as somebody who's independent. Highest and best use is a big part of tax assessment appeals. We talked about in most states where highest and best use is the law of the land. You've got to understand if your property is suitable for another use which may be worth more than a golf course. Sometimes you can use various alternatives in the states where it is highest and best use to help yourselves out. What is highest and best use? It's basically the result of 4 tests. What uses are physically possible on your property? What uses are legally permissible, i.e. zoning or restrictive covenants or deed restrictions that may exist? What uses are financially feasible? In other words, which ones can be profitable? And once you have those uses which are physically possible, legally permissible, and financially feasible, whichever one is maximally productive or creates the highest value is the highest and best use. Now, where you're dealing in a state where you have a continued use, you don't really have to worry about highest and best use too much. It doesn't really matter. Or if you're appraising a property that has restrictive covenants, in other words, it's a golf course that's part of a development, and that land has been restricted to use as either a golf course or as recreational space for the surrounding development. It's important to understand what the alternative uses might be. And they can be many, because you're usually dealing with properties of 150, 200 acres or more. One of the concepts that's often argued in some of the cases that I've seen is the concept of an interim use. Interim use is not highest and best use. And taxing authorities will often use the argument of, well, the golf course is there and we know it's going to be there for a while, but it's not the highest and best use. and therefore we want to say the golf course is an interim use, and we want to value the property based on the highest and best use. That's an argument that I've seen come up on several occasions, and it's a tough one to make because interim use is kind of a vague concept. And, you know, how long would golf course be the best use for the property until another more profitable use? Is it a year? Is it 5 years? Is it 20 years? So there's a time element to that interim use, which is very important. On the flip side, if you have a property which you want to keep as a golf course, and let's say it's operating profitably, and you don't want to pay taxes on it as a subdivision, which may put you out of business, there are a couple options that you have to change the zoning or change the classification of your property and modify the highest and best use. Many states, Illinois has this, Pennsylvania has this, have something called a clean and green program, and they call it a bunch of different things. But what it basically means is that you enroll your property in a program that keeps it as open space and clean and green for a period. I think in Pennsylvania it's 10 years. And if you develop the property before that, you have to pay back taxes. But in the meantime, if you don't, you get a reduced tax rate, and it helps golf courses stay in business. The other method is something called a conservation easement, which I'm sure many of you have heard of. A conservation easement is basically a gift of the development rights on your land to a qualifying 501c3 land trust. And what that means is that the land can never be developed in perpetuity. And if you qualify for the tax deduction, you can get a tax deduction from that. Plus, your real estate taxes should be reduced because the highest and best use is no longer for development. So those are some of the issues relative to highest and best use and their impact on golf property assessments. I'm going to take a minute here to answer this question. Will the lack of revenue this year in golf and food and beverage be a significant reason to request a lower valuation, thereby lowering the taxes for the current year? That's a question that I'm going to address in a few minutes as we get into the discussion on the impact of the coronavirus. And I'm presuming that the question relates to the impact of the coronavirus, which has caused the reduced revenue. So if you can just kind of hang on to that question, I'll address it here in a minute and get back to it. Now, one of the things that I really want to stress here is that in the assessment world, cost and the cost approach are very prominent elements. And one of my favorite quotes of all time is Warren Buffett's quote that says, "Cost is what you pay and value is what you get." And I think that is most applicable to the concept of why the cost approach is not a good approach to use in valuing golf properties, especially for assessments. I could get into some of the mechanics of the cost approach. I don't think we need to do that here. And of course, you know, I'm more than happy to answer any questions that you might have either today, or you can email me or call me or whatever it is, and I'm happy to talk about it. But I think that in a nutshell, and given that we only have an hour today, I wanted to kind of look at the cost approach from a 30,000 foot view and say, you know, geez, cost isn't value. and as Warren Buffett said, cost is what you pay, value is what you get. And I think that's very relevant to golf property assessments. Now we're at the point in our presentation where we're going to change gears a little bit. And we're going to talk about the impact of the coronavirus on golf property values. The elements that I want to focus on are the fact that golf courses have been, and certainly will continue for a while with coronavirus, they're in a buyer's market. For whatever reason, too many golf courses, a lot of people say, certainly in some markets that's true. The golf business has been a buyer's market, and buyers have often dictated the terms of golf courses that have changed hands. The concept of snapshot values, and basically that's going to address directly the question that was asked earlier. What are the determinants of value and how are they impacted by coronavirus? Long-term and short-term issues, distressed clubs and capital needs, personal financial stress, not the financial stress of the golf course or the club, but the financial stress of the people that are members or patrons of a particular golf course. And then some thoughts about the future and the future prospects for golf courses and golf course values. First of all, the buyer's market. There's been downward pressure on values for some time. And I think what's going to happen now is that there, unfortunately, are likely to be some courses that maybe have already been distressed, that the coronavirus could be the last nail in the coffin. So there could be further downward pressure on values. And what that means is, we don't know how long that might last. We certainly anticipate, I think, that there could be some closures and some bankruptcies. And by and large, that's likely to make the buyer's market more robust, if you will, which is a downward indication on value and should suppress values at least in the foreseeable future. Is it a year? Is it 2 years? I don't really know. I don't think anybody knows. Some people will tell you that by August, the economy is going to be recovered and everything's going to be great. Other people will tell you that it's going to take much longer for the economy to recover and return to normal. I think that as you move forward, one of the things that I've observed about the golf market in the 35 years that I've been doing this is that we deal mainly with snapshot values. And this really addresses the question of, will the revenue this year in golf and F&B be a significant reason to lower the most current or immediate future tax assessment? And the answer to that is yes, it should be. And the reason it should be is because in most cases I've observed that buyers of golf courses don't look at long-term cash flow estimates and projections. They look at either the trailing 12 months of cash flow or the first 12 months moving forward. Very rarely do they look beyond that in either direction. Yes, there have been in some regions, for instance, 2018 was a very, very difficult weather year. And in those cases, I know when we did appraisals, we tried to normalize values from that. The same could be said with the coronavirus, but I also think that the coronavirus is likely to have some lasting effects because, as we'll talk about in a minute, a lot of people are, their businesses are failing, they lost their job, they might not be playing golf for a while. So I think at least at this point, it's possible and reasonable to assume that there could be some longer term impact. Buyers perceive golf courses as risky investments anyway. And I think that with the potential failures that might occur and with looking at a not so attractive income and expense statement because of coronavirus, I think that that's going to potentially increase the capitalization rates, decrease the gross revenue multipliers, and possibly reduce values. So to answer your question, yes, I think it will be reason to appeal your assessment and seek a lower value. I think one thing that is really difficult to predict at this point is once we get back to normal, Are there going to be as many parties and banquets and events? Or is social distancing, at least in some form, maybe not to the same level that we deal with it now, is social distancing going to be a part of our lifestyle moving forward? Are we still going to shake hands on the golf course a year or two from now? I don't know those questions. Dr. Fauci says that we should get rid of the handshake. I think a lot of people listen to him. He's a pretty smart guy. I don't know the answer to that question, but I certainly think that all the golf courses that are out there that have banquet, event, or pavilion facilities where they can put 200, 300, 400 people in are likely to see a limited use of those facilities for at least the foreseeable future. Sure, people are still going to continue to get married, and people are still going to have golf events and golf outings. I just don't know how much of that socializing is going to take place. And if I owned a golf course right now, I'd be trying to figure out what alternative uses I could put that space to in my golf course facility. So I don't know what's going to happen, but I think those are some things that people ought to be thinking about. Determinants of market value. One of the things we look at is obviously that it presumes a sale. We remember the definition of market value from a little while ago. To who? It's really important to understand that if the market for golf course purchases declines, that those left in it will be dealing from a stronger position. So if that's who the prospective market is for a given property, we have to understand that, and market value presumes a sale. When we go to the assessor with our appeal, we need to explain that to him, and we need to articulate that to him in the appraisal, which is going to be the document that he uses or the court uses to set the assessment. There's declines in play. There's obviously the short-term declines in play because, in some places golf courses were closed for a month and a half. But I think there's also likely to be some declines in play from other sources. If carts are limited to one rider per cart, some people won't be able to get carts because there won't be enough at the golf courses. Maybe they can't walk. Maybe people are hearing that they can't walk to play golf, and they say, well, geez, I'm not physically capable of walking, so I'm not going to play golf. We've already talked about fewer and smaller gatherings and functions that may occur at our facilities. All these are going to impact the cash flow. I did an exercise a couple of weeks ago, and I took a property that we had appraised in December before coronavirus, and I made some assumptions as to what would happen to the different revenues, memberships, rounds played, et cetera, as a result of coronavirus for the next year. And it was really interesting because the gross revenue declined by 20%. The net revenue or net operating income declined by 50%. And that meant the value declined by 50%. So it was really impacted significantly, and the cash flow will be impacted by a higher percentage than what the gross revenue will be impacted. I think there's going to be some hesitant buyers out there. Is this golf course going to be one that survives that I'm thinking of buying? Since there's sure to be articles that say that, another 1,000 golf courses are going to close. And even though that may be good for the ones that remain, the guy buying it may not know that or may not be sure as to whether the one he's buying is going to survive. Neglected capital items. I would urge each and every one of you, if you're looking at a tax assessment appeal, to document all the neglected capital items that are on your golf course. We see a lot of golf courses where there are bunkers that haven't been rebuilt, irrigation systems that are 25, 30 years old. I was just at a course the other day where there was 36 holes, and one of the courses had an irrigation system that was 57 years old. Buyers are going to come in and they're going to look at that as neglected capital items. What kind of shape are the cart paths in? Get estimates for what it would cost to fix these items, because buyers are going to demand that they pay only for what's there, and if it needs to be fixed, they're going to take that off the sale price. Conversely, if you're planning on owning the property a long time, after the tax assessment appeal, you may want to formulate a capital plan. So, let's use those neglected capital items to your advantage while you can, in an environment where you can get potentially your assessment reduced. Economic fears. That's a big determinant of market value, because that's going to impact how many people play your golf course, what they're willing to pay. The only flip side of this that could be positive is that maybe there'll be lower interest rates and you can finance at a cheaper cost of money. And if all else were equal, which we know it's not, lower interest rates might indicate a lower cap rate, which could increase value. But I think with all the other things that we've talked about that are likely to occur as a result of coronavirus, that's not likely to happen even with lower interest rates. But that's a positive, or a silver lining in the dark cloud, if you will. Time's a big element here. Time's an unknown. We don't know how long the impact of coronavirus is going to last. We don't know, we just talked about this, whether the fallout is going to be long-term, short-term, both. It's really difficult to predict. We don't even know how long the coronavirus is going to be with us. We've heard everything from it'll be gone in a few days to we're going to lose 3,000 people a day between now and August, to it's going to come back in the fall and coronavirus will be around in 2021. So that's still to be determined. What will the cost of recovery be? There's sure to be not only lost revenue cost, but you're closing for a while. Now you got to open up. Maybe you have higher marketing costs. Maybe you have to fix some things that hadn't been attended to in a while. And you don't know how long the recovery period is going to be. A lot of people in the late 90s and early 2000s avoided selling their golf course properties because they figured in a few years or a year or whatever that the values and the play and all that stuff would go up. And the same thing with the Great Recession. Well, I think most golf course owners would probably tell you that those golf courses are not doing the revenues and the number of rounds that they did before the recession and before what I call the golf recession started in the late 90s, or I'll just say the early 2000s. And then the other question that you have to ask, which is also somewhat of an unknown and a time issue, is what's the status of the competition? Each and every one of these elements can be potentially, if they work in your favor, and when I say in your favor, I mean as it relates to reducing the value for tax assessment purposes, each and every one of these elements, if properly analyzed, can be used to potentially reduce your assessment. Time is a big and significant issue, and its unpredictable nature means that there's probably a lot of ways to address it. With courses that were previously distressed, I guess one of the first questions is how many were distressed and how many more might become distressed? Which of your competitors might not make it? What's the depth of the market moving forward? What are you doing to maintain or increase your market share? Do you have the ability to invest capital that's going to return value to the golf course? And what's your target market? The capital needs are really, really big here, because the easiest way to get a reduction in assessment is to say, I have X, my value is X, but I have Y, or $2 million that needs to be spent to get this property in a saleable condition. And it's something that is black and white, and it's not an opinion. It's, here it is. The cart paths are going to cost $400,000 to repave or rebuild. The bunkers are going to cost $150,000 to rebuild and put drainage in. The irrigation system is going to cost $1.5 million to replace. All those things are black and white issues, which are the best ways to motivate an assessor to negotiate with you. So that's really, really important, the capital element. Then there's the issue of your patrons, or in the case of a private club, their members' personal financial stress. How many of them have lost their jobs? How many of them have lost their businesses? A lot of golfers are small business people, just like us, just like you guys that own mom and pop golf courses, and they're small business people, and a lot of them are hurting right now. PPP notwithstanding, government help notwithstanding, PPP is not going to make the difference between businesses surviving and not. It may help a little bit, but I think stressed businesses are really going to struggle even with that help. So how many of these people have lost their jobs? How many people have lost their businesses, or have had to go out of business? People are going to be looking for deals. I'm sure you don't want to hear that, and I don't like telling golf courses that, because I'm not a big fan of the third-party tee time operators that suppress fees at golf courses. Are there going to be people that give up golf because they simply decide, well, I can't afford this luxury anymore? There are alternative activities that I think not only golf has to be aware of, which I think the industry is, but I think there are also alternative activities that maybe we can use our properties for, to broaden our base of revenues. For instance, in the winter, if you're in a northern climate, can you create cross-country skiing trails? Can you create walking trails that people can use? Obviously, there's a safety issue there. I'm not ignoring that. Some golf courses I've heard of have had nighttime activities, like the equivalent of a drive-in movie, fireworks on the 4th of July, things like that. So I think one of the things that I would do, and the clubhouse is the same situation, how can you use this real estate asset more effectively? I've written about that in the past. You're welcome to look up on my blog or call me, and I'll find some articles about that. But I think golf course real estate assets have to be used more efficiently. By design, golf is a very inefficient use of the real estate asset. I'm going to take a time out here for a question. Food and beverage, banquet, and tennis are leased at my property, and I am not receiving rent from these tenants right now. How do I use these facts to address my assessment? Their rent, of course, is necessary to pay my taxes on the very large clubhouse. I'm able to sell golf, but they are both closed in my state. Wow. I guess if you're closed now, you must be up in Massachusetts or New England, Vermont, New Hampshire. I think those are the ones that are closed right now, and maybe one other one. And you're welcome to comment on here if you like while I'm talking. But the bottom line is that if you can't get any revenue that is, and that condition is supported by the market, then that should be a reason for you to reduce your pro forma, which would in turn reduce the value of your property. Of course, it depends on whether the assessment is fair to begin with or not. So there, that's something that there's probably a lot of questions that I would have to ask you, and I would encourage you to give me a call and answer that question. Oh, okay, golf is open. tennis and restaurant are not, but golf can't support tax loan. Okay. Maybe we ought to take a look at your real estate tax assessment, see where it is, see what kind of revenues and stuff you're doing, and I would encourage you to give me a call or shoot me an email, and we can talk about that. Moving on here, I hope I answered your question as best I could, but like I say, I have a lot of questions that I would need to ask before I could totally answer that. What's the future hold? Well, I don't have a crystal ball here. I wish I did. But I think you're going to see golf courses evolve. And I think you're going to see better use of the property with alternative activities, more efficient use of the real estate asset. I mean, think about it. Most golf courses are 150, 200 acres. That means that in a half-acre lot development, you're talking about 300 to 400 houses. And that means roughly 1,000 to 1,200 people would use that property every day if it were plowed under and houses were built. And the most you can put on your golf course with a double shotgun is 288 people if you have two groups on every hole with a morning and an afternoon shotgun wave. So golf courses are by nature inefficient uses of real estate. I think having the necessary capital to compete is going to be really, really big, because golf consumers are very picky. Golf consumers are looking for this pristine green Augusta National type environment as much as they can get it. And golf is competitive. I don't have to tell you guys that. So I think you're going to have to make sure that there's capital available to do what has to be done to make your property competitive. I think golf courses are going to have to get more involved in their communities and get people not only to play their course, but also to take up the game. Golf is perceived as an elitist sport, not a community sport, and I think we need to change that. I have always felt that golf courses could be a great spot for an on-campus store, meaning a place where whoever's playing golf can stop, can stick around the golf course, have a burger and a beer, and have their shopping taken care of for them by filling out something that the person in the on-campus store can get ready. I'm not talking about a big grocery store and having gourmet meats or something like that, but almost like a convenience store that would be very small, very limited in scope, and provide a little bit of additional revenue. Maybe there's space in the clubhouse that could be used to accommodate other types of retail. I don't know. I don't have the answers to this, but I do know that golf has to become more efficient in its use of real estate. And then what other kinds of sports facilities can we put on golf courses? One of the reasons I have this picture up on the slide is because, as you can see, it's a pickleball court or a paddleball court, and that doesn't take up much space. It's very popular, and I think golf courses need to use the land resource that they have more effectively to get more people interested and involved. Quick question came in. Do you know if Kansas is a continued present use state or a highest and best use state? I don't know for sure, but I have not heard of it being a continued present use state, so I'm presuming it's a highest and best use state. But if you call me and let me know where your property is, I can look up a number of things, including the zoning of the property, as well as the law in Kansas, and we can find out how it applies to your golf course. If you're really fascinated by the valuation of golf properties at this point, I would encourage you to go to the website that's mentioned here and consider purchasing my book. Unfortunately, I don't control the sales or distribution of it, so I can't just email it to you or give it to you. The Appraisal Institute does that, and I have a contract preventing me from doing that. But it's a lot of interesting information, I think, and it may be relevant to your situation. If you're interested, and I'm not selling books because, like I say, I don't really get much out of it, and you do decide to buy the book, there's a promotional code, which is golf in capital letters, that can get you a 20% discount on a purchase of the book from the Appraisal Institute. I would also refer you to these articles that are on my website. Also, if you look at the bottom URL here, if you go on my website and search coronavirus, I've written a number of blogs in the last couple months about the impact of coronavirus and some of the things that have occurred as a result. And these articles may be of interest to you. And either, I know NGCOA is recording this webinar, and I would also invite you to just shoot me an email if you like, and I'll be happy to send you the PowerPoint presentation that has all these URLs and email addresses in it.